Welcome back, team. Now we're on to risk assessment. Remember, risk assessment always happens at which stage? At the planning stage. It needs to happen at the very start. Why do we do it? Main reason, as I'm sure you're all aware now, it reduces audit risk. What is audit risk? The risk that we give the wrong opinion. The risk that we say everything's true and fair when in fact it's not. So, how would a risk assessment reduce the audit risk? Well, it will help us identify potential problems early, okay, at the planning stage. We'll look at what's the risky areas and help us identify the potential problem. And therefore, what we can then do is address these risk areas. We can decide that we're going to do more testing or get an expert involved, whatever it might be, and therefore we will run a more efficient audit because we know about it already. Now, what it will also do is reduce any potential legal cases against us, which is really important because accountants and professions run on reputation, so it will also reduce potential legal cases if we did get the audit opinion wrong. Okay, how do we go about doing it then? The approach is very simple. First of all, by understanding the entity, by doing our analytical review, etc., by talking to the client, we will assess the risk. Then we will decide how we are going to address that risk, and then we will review the whole of it. We'll review risk as a whole and decide on how it affects our audit approach. Okay, does it affect the materiality? Do we decide we need to test more things? Whatever the effect on the audit approach. Okay, and that's why it all has to be done at the planning stage. Moving on from that then, I now want to go on to looking at risk in a bit more detail, looking at types of risk, the sort of terminology that comes up in the exam. You all know about the main one, so let's kick off with that. Audit risk, the risk that we will give the wrong opinion, okay? Why will we give the wrong opinion? Because we will miss a material, and I'm just going to call it MM now, a material misstatement. We will miss a material mistake, a material misstatement. So what you've got to do is you've got to decide, well, what will cause a material misstatement, okay? Now, the things that might cause it are, well, actually, what I'll do is I'll give you an approach in the exam. This is what you should do in the exam, okay? 1. Look for the risk areas. It's going to be pretty obvious. I'm going to do exam questions with you anyway, but it's pretty obvious. Anything they talk about, it looks like a risky area, then there's a potential we might miss a material misstatement, so there's an audit risk there, okay? Then you also look for poor controls. Whenever the examiner talks about the controls, you're looking for poor controls. That's an audit risk because potential misstatements. And you're also going to look for the wrong treatment of items. The wrong treatment according to IFRSs. Okay, so you need to know your IFRSs a little bit. Make sure that they're treated. We're not saying that they have done it wrong, but there's potential for the wrong treatment. So once you've looked for those things, then you think to yourself, how can these lead to AMM? And you'll state that in your answer. You will say it could lead to an understatement of liabilities. For example, they're talking about a potential environmental issue that we might be sued on. And if we haven't provided for it, well, that's a potential understatement of liabilities, understatement of expenses. Write all that down, and therefore that increases our audit risk. Okay. How do I know that they might lead to it? Well, I'm looking for wrong treatment, poor controls, risk areas. Okay, so you do need to know your knowledge of accounting standards, not massively, but a little bit to do that. And then the third thing I would say is also just look for disclosure, or look for really, if I'm honest, non-disclosure of items. Okay, you give an audit opinion not just on the numbers but on the disclosures as well. Okay, so anyway, that is our audit risk. Now let's have a look at something, I don't know, engagement risk. I think would be a good one to do now. An engagement risk is the risk that we take on the wrong sort of client. So clients with, what is the wrong sort of client? Because reputation is really important. So obvious ones would be clients with poor ethics, clients with lots of going concern issues, clients with lots of qualified reports in the past. Auditors have had problems in the past, so lots of qualified audits. Clients with very short deadlines. The year end is the 31st of March, and they want the audit done in a couple of weeks. That could cause us potentially quite a lot of problems. Key staff leaving. Then we're going to have problems with the controls not working well, so maybe we don't want that sort of client. Laws and regulations, the potential again, lots of laws and regulations means potential for us to miss something, particularly if we don't have experience and knowledge of that client. So that's another engagement risk, if we don't have the potential or the correct experience and knowledge of the client. Any takeovers may be pending as well. That would be another one. But anyway, yeah, so that's it. The risk that we're taking on the wrong sort of engagement, ones that's not suited to us. I'm just going to put one more in here in this bit, sampling risk. We know that we do audits based on samples. We don't test 100%. And so therefore the sampling risk is that the sample conclusion is not the same as the conclusion if 100% was tested, if the whole of the population was tested. So we get a conclusion from the sample, but actually, if we'd have tested 100%, we'd have reached a different conclusion. So that's a sampling risk. So get to know those three risks, and then I'm going to give you three more risks, okay? So three more risks. I've done it like this on purpose because audit risk as a whole is basically made up of inherent risk times by control risk. So the more inherent and the more control risk you've got, the bigger your total audit risk is. And it gets even worse times by detection risk. Okay, now what is inherent risk then? Inherent risk is just the risk of the business itself. Okay, the type of business that you're in. So if it's a cash-based business, if it's a nightclub or something, then there's a big risk there inherently in that business, and so therefore we're going to have to do more work on it. The audit risk will get higher. Control risk, of course, control risk is the risk of a material misstatement due to poor controls, due to the controls either not working properly or designed badly in the first place. So if you've got very poor controls and you run a nightclub, our audit risk is absolutely huge. And so therefore, detection risk is the only one that we control. So detection risk is the risk that our procedures, don't detect material misstatements. And the great news is that we can influence that. Obviously, the more the procedures, the more testing we do will give less detection risk. Okay, you probably won't get asked to do numbers anymore. You used to a long time ago. It's kind of changed a little bit now. But more procedures, less detection risk. So what tends to happen is you can give these numbers. So inherent risk times by control risk times by detection risk equals audit risk as a whole. Now let's say that you give everything at a range of 1 to 10, okay? And remember, detection risk is the only one that we can control ourselves. So let's say that we're happy with an audit risk of 100. And the inherent risk of this company of company A is 2, so it's very low. This company we're quite happy with their sort of business. Their controls are also pretty good, so that gets out of 10 a 3. So therefore, you would just then say, as an auditor, you'd then say, right, get my calculator out. 2 times 3 is 6, and therefore, if I divide 100 by 6, my detection risk can be, and I'm doing this on purpose, that I'm working it out, is that I'm happy to have a very, very high detection risk, 16.67. Okay, why am I prepared for it to be so high? Because inherently the company is not very risky, the controls are very good, so it's not very risky, so I'm allowing my detection risk to be very high. So if my detection risk is very high, that means I don't do as many procedures. Remember, procedures are how I affect my detection risk. So if I'm happy for detection risk to be high, I can do less procedures, I can do a more efficient audit. Now let's have a look at company B then, who is massively got a huge risk there, and let's say they've got a fairly high control risk as well. So 9 times 7 is 63, so 100 divided by 63, I'm only allowing myself, therefore, 1.6-ish, okay, to get to my same audit risk that I think is acceptable, 100. And as I want that detection risk to be very low, then I need to do lots of testing. I need to do lots of procedures. If I'm going to get my detection risk to be very low, I need to do more procedures. I don't think you'll have to do the numbers in the exam, but I think it is quite important, quite nice to think about it, that if something's got a high risk in terms of controls, in terms of their business, then I need to do a lot of testing. I need detection risk to be low. If I'm quite happy with the inherent and the controls, and I think they're really low, then I'm happy to do less testing and have a higher detection.